introduction of Jessica right before she does her little presentation to us. So today we have the pleasure of hearing from Jessica Oates. Jessica is a mortgage broker with DLC Harmony Mortgage Group. And upon joining our chapter, it was immediately evident that she was going to be an invaluable resource for everyone. She's a mother to twin 4-year-olds who keep her on her toes, as you can see. And Jessica feels that keeping them alive on a daily basis is a significant accomplishment. And as a parent myself, I completely agree with that. So there are numerous steps involved in purchasing a home, most of which are complicated. Jessica has positioned herself as an expert in the mortgage process, which helps take some of the stress off of her clients. This allows her clients to focus more on their dreams of purchasing a home or other property and to approach the market with confidence in what they can achieve. Jessica is a licensed mortgage broker who finds the right solution for each individual client. Whether you're purchasing, refinancing, self-employed, seeking a reverse mortgage, like she mentioned this morning, or looking to pull equity from your home, she has access to alternative lending options as well as the standard purchase and renewal options in the mortgage. Or in the market, sorry. So now let's hear more from Jessica and her business. Take it away.
Thank you, Kareen. Oh, hold on, we're frozen. There we go. Good morning, everyone. Thank you for that awesome introduction. It's always nice to hear, that I'm good for the team. So thank you so much for the opportunity to present to you all this morning. I figured since the Bank of Canada has now made their announcement, the world is going crazy. Why not break down some mortgage myths? Let's just take a little bit more stress away from the people. So we're going to get straight to it. 5 mortgage myths debunked. So myth number 1, you need 20% down payment to buy a home. This myth kills my soul. I have seen many a client come into the office ready to buy a home. They tell me that they finally have their 20% down payment saved up after saving for 3 years. I run all the numbers for them, and I find out that they've been priced out of the market in the 3 years that they've been saving and now no longer qualify for a home in their price point. When I tell them this, their excitement pops like a balloon and they say, well, I thought I needed 20% down payment. Nope. This is a myth. When purchasing an owner-occupied home, aka a home you're planning to live in, you only need 5% down payment for the first $500,000 of the purchase price. After that, you do require 10% of the purchase price from $500,000 to $1 million, aka $999,999. And when you get over $1 million, you do require 20% down payment for a home only then. When buying a home under $1 million, you have less than 20% down payment. You will have something added to your mortgage transaction called mortgage insurance. This ranges in cost up to a maximum of 4% of the mortgage amount and is done under one of the 3 insurers in Canada, CMHC, Sagent, or Canada Guarantee. This helps guarantee that if you were to default on your mortgage, the lender can utilize the mortgage insurance to help recoup their money. Myth number 2, you will not be approved for a mortgage if you are self-employed. Applying for a loan, much less the mortgage when self-employed, can be particularly tricky. At Harmony Mortgage, we do have standard and alternative lenders that will entertain self-employed income. The biggest thing to remember is that we will need 2 years of filed taxes to work off of when qualifying you for a mortgage. This is not 2 business years, this is 2 tax years. Even if you're moving from an employed position to a self-employed position, doing the exact same thing, you will still need 2 years and the clock starts fresh when you go to self-employment. Another option for self-employed persons is the ability to gross up their income. This is adding back a percentage of income that you may have written off to allow for additional income to be used on the application. We also have lenders that will allow for bank statement income to be used, which is where we take 6 months of your business bank statements, add up all the business deposits, double it, and then take away your expenses and overhead to get your yearly income. This is helpful if you have a ton of write-offs because we actually can utilize almost all the income that exists, minus just your basic costs. Either of these options can be particularly helpful when trying to qualify. Myth number 3, bruised credit or bankruptcy means I will never qualify for a mortgage. I hear this way more often than I should. This is not true. We have lots of lenders that work with clients who may have bruised credit, low credit, no credit, or they've had consumer proposals or bankruptcies in the past. Of course, these all come with stipulations, so we're going to break down a few. First, if you're trying to access a standard lender with no fees, then you will need a credit score of at least 680 for one of the borrowers on the file. The second party who cannot be the main income earner needs to be between 600 and 680. This rule changes a little for someone who has no credit, or new to Canada, but this is the main rule to follow for standard lenders. The other thing to keep in mind is that you may be subject to different debt servicing rules if you have a lower credit score. So you may not qualify for as much as you would with a higher credit score. So how does bankruptcy play into this idea? Trying to access a standard lender again after claiming bankruptcy, it is important to remember the 2-2-2 rule. You must be 2 years from the bankruptcy with 2 lines of revolving credit in good standing with no missed or late payments, with at least $2,000 in limits. Another thing to touch on is that missed and late payments do happen. Standard lenders are more strict around these, which means that we may be looking at alternative lenders, but as long as the information to the lender makes sense, then don't worry. For example, you were on maternity leave and waiting for EI to start and had to decide between paying your car loan or putting food on the table. So your car loan payment was late. They accept this. Maybe you were also quite sick, unable to work with no benefits, so your mortgage payment lapsed a month. They will also accept that. As long as it makes sense to the lender and the explanation, makes sense, we have options. Don't lie or feel like the mortgage broker or lender is judging you. They've seen and heard it all before. We just need the basic information. We can continue on with the application. And if questions come up later, you can answer them and we can move on. Myth number 4, you will not qualify if you are new to Canada. This is wrong. Being new to Canada does not stop you from qualifying for a mortgage. But the fact that Canada welcomes anywhere from 250 to 400,000 immigrants a year and up, they all need somewhere to live. Lenders do offer new to Canada programs that can be taken advantage of. Having no established credit history in Canada can be very daunting. So of course it is helpful for newcomers to build their Canadian credit history, but it is not 100% needed. The programs available evaluate a borrower's entire financial story, including future potential earning, current funds available in their account, assets that they have, etc. It all kind of plays a part in the overall story. Number 5, your bank is the best place to get a mortgage. This is no longer true for most people. Having options outside your bank allows you the chance to access lower rates, alternative lending options, or different mortgage products to fit your current needs. Since the bank is only able to offer you their single line of rate products, they do not have the flexibility to look past their products and see if there's something better or different available that you should be considering. As a broker, we can take into consideration all life and work factors and then match you with the best lender and best rate product. It has also recently been practiced to mortgage not where you bank. This helps create some separation between the biggest asset that you own and your bank accounts in case of financial troubles. If you have a specific employment situation and need access to products such as stated income, bruised credit programs, or extended debt service ratios, then looking outside your bank would be the first thing you should do. One of the main positives of using your bank, though, is that there will be less paperwork since they already have access to your direct deposit information. They can see exactly how much income you're depositing and will require less documentation than a broker will ask for, but at what cost? Just something to keep in mind. So now that I've debunked a few mortgage myths, there are a couple more points I would like to touch on. The first, that we should all know by now that using a broker allows you access to tons of different lenders. They are also able to bring a different knowledge base to the table than your standard bank mortgage advisor. Also, did you know that there's no official schooling, licensing, or registration needed to offer mortgage services and products at a bank? Yes, of course they do standard training, but mortgage brokers go to school, they write exams, they learn legal definitions, and they bring to the table a much more expansive knowledge base. This is important to remember. I personally dealt with a few instances just this year where the bank overpromised, underdelivered, and almost cost the client from being able to close on time. This can open the client to huge ramifications and possible legal action. Was I able to save the deal? A few sleepless nights on both myself and the client's end saw us get everything in line and keys were in hand on possession day. Brokers do have access to most of the big banks. We've been locked out of a few broker channels, not going to name them, but the majority we can offer and close deals with. We may even be able to offer better rates than the branch. The biggest thing to remember when picking a financial institution is to hold your mortgage, is that penalties can greatly vary in cost. When dealing with a monoline mortgage lender, the posted rate is the rate. When dealing with a standard bank, the posted rate is one thing, and then there's a discount applied to get to the actual rate. When it comes time to calculate the penalty, they fall back to the higher posted rate, which may end up costing the clients thousands more than it should have. I've seen one difference where monoline would have cost them $5,000. A standard bank cost them $33,000 to cancel and move their mortgage to a new lender. In the end of the day, it can be really, really devastating. So this is very important to remember, something that is discussed when I explain the difference between rates and different rate options. So thank you again for joining me in my presentation. I'm breaking down 5 mortgage myths. So now that I have melted your brain with information this early in the morning, does anyone have any questions?
Very good presentation, Jessica. When it comes to prepayment penalties, I just had to pay a $10,000 penalty. What is a way to mitigate that before going into the mortgage?
So something that we try and discuss with borrowers before they sign anything is we ask them what their short and long-term goals are. So if they have an idea that they're going to be breaking their mortgage at year 2, 3, year 2, 3, or 4, we try and, put them into a variable mortgage because the penalty on those is extremely low. It's only 3 months interest. If you're doing a standard bank and you're doing a fixed rate, you are going to have that higher penalty and there's nothing we can do about it. You can sometimes approach the bank and ask them if they would reconsider lowering your penalty if you continue to bank or hold their mortgage with them. But 9 out of 10 times, they're just going to tell you that's not happening. So unfortunately, once you're in it and you haven't been explained all the information, there's nothing we can do after that point. But prior to that, we try and do as much education as we can around rates, different rate products and different penalties so that people don't go in with their eyes closed and then get smoked with this big bill at the end, because it can definitely hurt, sale proceeds or just even trying to renew and move your mortgage to a new place. So hopefully that answered your question. Awesome.
I have a question. Oh, somebody else going ahead?
No, go ahead. Sorry.
Okay. I have a question. How come CHMC doesn't finance you for leasehold property?
They do, actually.
Oh, they do. Okay.
So leasehold properties, there's 2 sides to the coin. So we have a lot of Indigenous land right now that is being developed, and we're having a lot of builds on their land. And with those, we have lenders that will give mortgage insurance and allow for that 5%, 7%, 10% down payment on those homes. We have very specific lenders that will do it. And the process that goes into reviewing the leases and all of the documents that go with it it's extremely lengthy. So what ends up happening is we have lenders that have pre-approved those leases and we can go right to them. If we're trying to get it approved through a lender that hasn't approved that lease, but we know may, we can submit all the documents to their legal team to review, and then they'll come back to us letting us know if they're going to approve it or not. In regards to other properties that cannot be financed or cannot be insured on, so we have a lot of issues around not trailer parks, but modular home parks where you pay a pad fee because you don't own the land. If they ever needed to foreclose on your home, they can't get their money back because you don't own your land. So they're going to have a really hard time, getting their money back. The marketability is not very good. So they are not going to be able to give you, that insurance level, which means you're going to have to go in with a lot more money down than other properties where you can actually access the mortgage insurance.
Okay. All right. Thank you, Jessica.
You're welcome.
Yeah. Thank you, Jessica, for such an awesome presentation. I have a question. I don't know, do you do commercial mortgage too, or?
Personally, myself, I don't do commercial mortgages, but I do have a few partners that do commercial mortgages.
I have some questions. Sorry,
so yeah, we keep those
commercial, but that's okay now. So it's all good.
I can connect you to somebody. If you want to just take down my phone number, you can shoot me a text and I can connect you with a commercial broker.
Oh, wonderful. I'll do that. Thank you so much.
Yeah, no worries.
Thank you so much, Jessica. Thank you. That was wonderful. If any